What we want to look at is on IFRS 15 on revenue from contracts with customers. That's the standard we want to look at today. And majorly, when we talk about revenue is one of the most important items in the financial statement. And usually, it can be attributed to the growth or the performance of a company. A company that has high level of revenue is assumed to be doing very well. Or a company that is increasing its revenue, that kind of company is assuming to be growing. So this is a very important standard. And in the past, we have had some standards that deal with revenue recognition. We used to have IS 18 that dealt with revenue, and there was IS 11 which is relating to construction contracts, but majorly that standard also addresses how construction companies, or when you undertake a project that takes a long period of time for you to deliver that product, how do you recognize revenue on them? So, and we find ourselves having several revenue recognition criteria or several guidelines for different industries. Before now, it was quite difficult for us to recognize revenue in using a single framework until this standard came on IFRS 15. It helped tremendously in aligning how all organizations recognize revenue. So let me go straight to the point. So the first thing I want you to be aware of is the objective of IFRS 15. What does IFRS 15 wants to achieve? Is quite straightforward. What it wants to achieve is that revenue that is recognized in the statement of profit or loss must depict the consideration that is expected by an entity from the transfer of promised goods and services to the consumer. What this is saying is that the revenue or the amount you can recognize as revenue must reflect or must depict the amount of money you are expecting or the consideration expected by an entity from the transfer of promised goods or services. Therefore, before revenue or that revenue you see in the P&L must represent the money you are expecting for the goods you have already rendered, which goes to show that if you have not rendered a service, if you have not transferred a promised good or services, you should not recognize revenue. You cannot recognize revenue until you have transferred the promised good or service. And that's the core of IFRS 15. That revenue can only be recognized in the books when you have transferred the goods or services. So if you are selling bottled water, you cannot recognize sales of bottled water until you have transferred the bottled water to the customer, whatever it is you are selling. So revenue is only recognized when, or the revenue recognized in P&L must depict the consideration expected by an entity from the transfer of promised goods or services. So that's the first and most important point I need you to hold. Now, the second aspect of this standard is recognition and measurement of revenue. How do you recognize and how do you measure revenue? You see, according to IFRS 15, revenue is now measured using a 5-step model. So majorly what I want to teach you today fundamentally is this 5-step model. So before you can recognize revenue, you must follow these 5 steps. Now, what's the step one? The step one is that you must identify the contracts with customer. That is, before we can recognize revenue now, there has to be a contract with the customer. And when we say a contract, of course, is an agreement between 2 or more parties that create enforceable rights and obligations. And I've mentioned contracts before under financial instruments. Financial instrument was a contract. Under leases, we mentioned about contracts. Here too, we are saying that the first step in recognizing revenue is that there has to be a contract. And I've mentioned severally that the core of a contract is that it is an agreement. There must be an understanding and it must be enforceable. Okay, it must have legal and economic consequences. A contract does not have to be in writing. Okay, now, according to IFRS 15, a contract with a customer is within the scope of IFRS 15 only when these 5 are present. So for your exams, you have to know these 5 because I have asked it before. So a contract is a contract within IFRS 15 if it has these 5 criteria. Number one is that the parties have approved the contract, whether in writing, orally, or in accordance with other customary business practices, and they are committed to carrying it out. Okay, so the parties have approved the contract. That's one. Before there can be a contract, the party must have nodded to the contract. They must have given the contract a go-ahead. They must have approved the contract. Number 2 is that each party's right regarding the goods and services to be transferred can be identified. So the parties must know what they are supposed to do. The person that is supposed to deliver goods should know that, okay, this is the goods he's supposed to deliver. He's supposed to deliver. The person that is supposed to receive money must also know himself. So each party's right regarding the goods or services to be transferred can be identified. And number 3 is that the payment terms for the goods or services can be identified. So we must know when payments are going to be made or received by each party. So the payment terms must be, so if it is 30 days credit period, if it is that, okay, we'll pay 70% at the initial stage, then we'll balance up the remaining 30% later. There has to be payment terms before we can have a contract. Another one is that the contract has a commercial substance. That is, the risk, the timing, or the amount of the entity's future cash flows is expected to change because of the contract. So when we say the contract has commercial substance, what that means is that money must change hand. Money must change hand. One person must be giving another person money. So there must be changes in risk, timing, or amount of future cash flows is expected to change because of the contract. And finally is that it is probable that the entity will collect consideration to which it will be entitled to. So the entity must be sure that he will collect his own money. That is, the seller must be sure that he will collect his own money. So these are the 5 criteria that must exist before a contract can qualify in IFRS 15. Another thing is that when an entity receives money and he has not transferred goods or services, you collected money, but you have not transferred goods to the customer, that must not be recognized as revenue. I told you earlier, that was the first thing I told you about the core objective of IFRS 15. That cannot be recognized as revenue. Rather, you recognize it as a liability. we call it contract liability. So when you collect money for goods you have not transferred to the customer, it's a liability in your hands. You cannot recognize that as revenue, except if that money you collected, if it is non-refundable, or you don't have any obligation to transfer goods or services, then in that case, you might go ahead and recognize that as revenue. Now, still on contract, it's possible that separate contracts can be combined as one. Okay, so if an entity enters into a sales contract with a customer and they now have multiple contracts, let's say he wants to do what do they call this company? Let's say he wants to do social media, digital marketing service for a customer. So they now had a contract for design, because you have to design what you want to post first. They did a contract for design. Like, okay, this is what we will pay, this is the duration, whatever. They did another contract for the social media advert itself and all of that. So if a company enters into an arrangement like that and it signs separate sales contracts with a customer, what we are saying is that, is it possible that those contracts can be combined? Instead of treating them separately, why can't we see them as a single contract? Why can't we see them as a simple contract? So the standard said that it's possible to combine two or more contracts, okay? If these following criteria are present, then just combine those separate contracts. Number one is that the contracts are negotiated as a single commercial, as a single package with a single commercial package. So the contracts are negotiated as a package and they have a single commercial package, commercial objective. Number two is that the amount of consideration to be paid in one contract depends on the price of another contract. And number three is that the goods or services promised in the contract can be delivered in a single contract. So if these three criteria are present, then go ahead and recognize that contract as or those separate contracts as you can go ahead and recognize them as a single contract. I'm in class, Elijah, I'll call you back. Now, that's contract combination. Another one is it's possible that we can modify a contract. Or what is contract modification? So a modification occurs where there is a change in the scope or the price of a contract that is approved by the parties. So when the scope of a contract changes or the price of a contract change, that is a contract modification. So when there is a contract modification, can we treat that, or can we treat that modification, that change, as a separate contract? So IFRS 15 says that we can treat it as a separate contract if these two criteria are present. Number one is that the scope of the contract increases because of the addition of promised goods or services that are distinct. The scope of the contract increases because of the addition of promised goods or services that are distinct. That is, if the scope change and the change is as a result of addition of promised goods or services. So maybe the contract before was that you should deliver 5 packs of bottled water. So the customer now requested for additional 3 parts. So that means there is a change in the initial scope, right? Number two is that the price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services. Again, a modification can be treated as a separate contract if the price increases by an amount that reflects standalone selling price of the additional goods or services. That is, the changes or the additional price of the additional goods that the customer is requesting. If that additional price is the price you will have sold those goods normally, if it's the price you will have sold those goods normally, that's what they mean by standalone selling prices. Then that means, yeah, it should be a separate contract. So a contract modification can be a separate contract if the change in scope represents addition of promised goods or services, and if the change in price reflects standalone selling price. Like I said, standalone selling price is the price at which an entity would sell a promised goods or services separately to a customer. Okay. Now, let's look at the question. This question says that an entity promises to sell 120 products to a customer for 12,000 naira, that is 100 naira per product. Okay. 120 products for 12,000. Okay. 100 naira per product. That's 100 naira times 120. Okay. The product are transferred to the customer over a 6-month period. The entity transfers control of each product at a point in time. After the entity has transferred control of 60 products to the customer, the contract is modified to require the delivery of additional 30 products to the customer. When the contract is modified, the price of the contract modification for the additional 30 products is an additional 2,850 or 95 naira per product. The pricing for the additional products reflect the standalone selling prices of the products at the time of the contract modification, and the additional products are distinct from the original products. Does this contract modification constitute a separate contract? Okay, so like I've explained earlier, the initial contract is that I want to sell 120 products to my customer and I'm charging 100 naira per product. So after I've transferred 60 of these 120, the contract was modified. The customer was requesting for additional 30 products. And this additional 30 products now, I'm selling it at 95 naira per product, totaling 2,850. But they told us here that the pricing of the additional product, that is the price of these 30 products, which is 95 naira, reflects standalone selling price. So they're now asking us that, should this modification be a separate contract? They have already told us the answer. Yes, it should be a separate contract because one is that there was a change in scope, which is addition of which there was a change in scope that resulted in additional promised goods or services, that is these 30 products. And they have told us that the price of those products reflects standalone selling prices. That is, the price at which the entity will sell a promised goods or services ordinarily, separately to a customer. So this is a separate contract, and you have the solution here already. So, okay. So the thing about contract modification is that where there is a modification, it's like 2 or 3 things can happen. Is either it will result in an additional or a separate contract, which is what we have explained here. This solution shows that this arrangement now will result in a separate contract. But there are some contract modification. That was what I was trying to explain here. That the 30 product might not reflect standalone selling prices. So in those cases now, that modification will result in termination of the original contract and the creation of a new contract. Okay, so it can result in termination of the original and that we are creating a new contract entirely. So they have asked that before, so you have to be very careful. So contract modification can result in having a separate additional contract. That's one. Number two is that it can result in termination of the original contract and the creation of a new contract. Okay, take note of that. Now, we are done with step one. I can ask any of this, so you just need to master and study it with those examples I gave. This class is so quiet. Any questions to this point? Okay, now, I mean, we can go to step two from the body language of the class. Now, in step two, which is identify the separate performance obligation. Identify the separate performance obligation. So, the key thing here is this. What is a performance obligation? When we say we should identify the separate performance obligation, when we say a performance obligation refers to the promised goods or services. Okay? Is the promised goods or services to be transferred. So if you want to sell bags, school bags to customer, your own performance obligation is those school bags. If you want to sell books, your performance obligation is those books. If you want to sell shoes, your performance obligation are those shoes. So when we say identifying separate performance obligation, we are saying that the step two towards recognizing revenue is that we should be able to identify which goods are we transferring. Which goods are we transferring? Okay. Now, the first thing is this. When it comes to revenue recognition, revenue is usually recognized on distinct goods or services, or on each performance obligation, you recognize revenue on that separately in the books. So one of the core job when it comes to revenue recognition in this step two is for you to be able to identify that when is a promised good or services said to be distinct? When is it said to be distinct? Because a company would account for performance obligations separately only if those goods or services are distinct. So a good or services that is distinct, you recognize revenue for that one separately from other goods or services that are distinct. So the key and big question is that when is a promised goods or services said to be distinct? It's straightforward. When it is sold separately, or when it has its own profit margin. If you can sell it separately to the customer, then it's distinct. Or the standard now went ahead that a promised goods or services to a customer is distinct if the customer can benefit from the goods or services either on their own or together with other resources that are readily available to the customer. So the customer can benefit from those goods or services on their own. Number two is that the entities promised to transfer the goods or services to the customer is separately identifiable. And when we say separately identifiable, what separately identifiable means is that it does not, it is not an input to another good or services. It is not an input to, it doesn't rely on another good or services. So an example is, for example, now, let's say net worth now. Let's say net worth, our school. We are offering tutorial services to you guys. So let's say that we also give you books, like those books we are transferring to you now. We also give you. So though, because those goods are soft copy, so if we're giving you, let's say, hard copy now, so can we see, because we usually charge everything as one, we don't collect money for books separately, but can we see that books as a separate goods or services or separate performance obligation from the tutorial service itself? That is what we are saying. But if you analyze it critically, you will see that that books is a separate performance obligation, even though we don't charge separately for it. Because ordinarily, we have some students that will come and buy books and will not come to class. They want to buy the books that they want to go and read. Yes, we have students like that. So that goes to show that that book, the customer can benefit from it on his own. And it is separately identifiable because it doesn't rely on the tutoring service. It can work, it can satisfy the customer on his own. So ordinarily, we should recognize revenue for the book separately from the revenue from the tutorial service, because those services are distinct. So you see, what we are talking about now is speaking to situations are painted for net worth now. You see, there are a lot of entities that will just bundle services together and they will just charge a singular amount for everything. What we are saying is that if those bundled, inside those bundled goods or services, if those individual goods or services, if they are distinct, IFRS 15 says that we need to be able to know how much revenue has been made on that, and each and every one of the items that are distinct. We need to know. We need to know. And these two criteria is what we are talking about. And this other one is speaking further to what we mean by separately identifiable. Okay, so everything I've mentioned about step 2 is just this separate performance obligation, speaking to when entities bundle goods or services together. We need to look at it very well, that are they separate performance obligation? Are they distinct? If they are distinct, you need to recognize revenue for them separately. And before you can see they are distinct, you must establish that the customer can benefit from those goods or services either on their own or together with other resources that are readily available to the customer. And also is that the entity's promise to transfer the goods or services to the customer is separately identifiable. That is, it does not rely, it's not dependent on any other goods or services. It can stand on its own. Okay, now let's look at the question to strengthen our understanding. So we look at Wiki Limited. A contractor enters a contract to build a hospital for a customer. Wiki Limited is responsible for the overall management of the project and identifies various goods or services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. Okay? And I said, Wiki Limited and its competitors regularly sells many of these goods or services separately to other customers. Explain whether the promised goods or services can be treated as a separate performance obligation. Okay, so this question is just in line with what I've just explained. So this guy wants to build an hospital for a customer, and the services involved include engineering, site clearance, foundation. So all of these are different services. And I said that Wiki Limited and a competitor regularly sells many of these goods or services separately to other customers. Explain whether the promised goods or services can be treated as a separate performance obligation. So it's like asking that, can engineering be, should you recognize revenue on engineering separately, site clearance separately, foundation separately, procurement? That's what this question is asking. Or should we see all these services as one? So let me give you an opportunity to talk so that you will not say I'm the only one that have been talking since. So who has ideas here? Are we treating these, each of them on their own, or we put all of them together as one service? What do you think? So if you don't have an idea, number one is this. Let me look at the one that is clear, that will be, you will understand. Let's say foundation now. Can this customer, if you prefer foundation, we give him a contract for foundation and we build the foundation, can the customer enjoy benefit from this foundation alone? In this kind of arrangement, no, the foundation will not be useful. We also site clearance. What the customer needs is a hospital. So each of these services within this contract cannot, because they are not distinct. Because based on the two criteria I gave you above, the customer cannot enjoy benefits alone, and they are not separately identifiable. They don't meet those two criteria for distinct. Because of this structure, before you can do foundation, you must have done site clearance. All of them is like they are an input to one another. They are dependent on one another. For that reason, this entity or Wiki is going to see all these services as a single performance obligation. All of them as one. And that is it. So, and that's the solution I have here for you. Let's look at another question. Let's see if you'll be able to try this one. It says that the Kako Limited, a startup tech company, develops an app for use by businesses. It enters into a contract with customer to supply the following: license to use the app, installation service. This may require an upgrade to the computer operating system. We have technical support for 4 years and 3 years of update. We're now told that the installation service can be performed by Kako Limited customers, and it does not modify the app. They said that the app can remain functional without the update and technical support. Explain whether the promised goods and services can be treated as a separate performance obligation. So can we treat each of these items as separate, or should we treat all of them as single? Again, from here, without wasting our time, we're told that the installation service can be performed by Kako's competitors, and it does not modify the app. So that means this installation is a standalone. The app can remain functional without updates. So this update is not even necessary. And yeah, so that means each of them can stand as a separate performance obligation. They don't rely on one another. They are separate. So that means we should recognize revenue on license separately. We should recognize revenue on installation service separately, technical support separately, and 3 years update separately. Because the customer can enjoy benefit from each of them separately. Okay, that's that for step 2. Now, the step 3 for recognition of revenue is to determine the transaction price. And the transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange for transferring goods or services, excluding amount collected on behalf of third parties. For example, is VAT. So this is similar to saying the selling price or the amount on the invoice. That's the transaction price. Is the amount of consideration the entity expects to be entitled to. But mostly, you know that when you issue out invoice, you will add VAT. Okay? Please don't treat VAT as part of revenue. VAT is not part of your revenue. So is excluding amount collected on behalf of customers. And when we are talking about transaction price, it's possible that we could have variable transaction price. It could vary. So when transaction price varies, we need to consider the effect of that. Okay. So this variable means usually maybe the customer has right to return the goods, or probably we said we're going to give him a discount or a bonus, something like that. So all of that, if we have variable amounts within the contract, we need to consider it now that, okay, this selling price might change. Another one is also is the time value of money. That is, if you sell to somebody on credit and you won't collect your money until after more than 1 year, standard says that you need to consider time value of money, which goes to show that you probably recognize the transaction price at the present value, so that you'll be recognizing it at the value of today. Also, it's possible that the transaction price could be non-cash. It's not every time that the customer will pay in cash. It could be non-cash. So that means we'll probably get the fair value of the non-cash consideration. And if there is any amount payable to the customer, that also should be noted. Okay, so transaction price majorly is just the selling price of the goods. You need to determine it and putting all these into consideration. Now, let's look at the question. This one says that Mayfair supplies laptop computers. On 1st of January 2007, Mayfair entered into a contract with the customer under which the customer was to purchase laptops at $500 per unit. The contract states that if the customer purchases more than 500 laptops in a year, the price per unit is reduced respectively to $415 per unit. Mayfair year end is 31st December. Okay. I think this is the one where there is a variable consideration. Because from here, ordinarily the guy sells the laptop at $500 per unit. But now they are saying that if the guy is able to buy up to 500 laptops, the guy is saying that he will reduce the selling price retrospectively to 450 naira. Retrospectively means that all the quantity has purchased, even though he has been charging 500 naira before, that he will reduce it to 450 naira to him. So there is a variable consideration. So how do we determine this? They have to give us some assumption. So he said A, as at 31st March 2017, the customer had bought 70 laptops from Mayfair. So Mayfair therefore estimated that the customer purchases would not exceed 500 in the year end, and the customer would therefore not be entitled to the volume discount. Okay. So they gave us assumption A, that the guy has only bought 70, so he will not get it. That's at the end of the first quarter. At the end of the second quarter, the customer expanded rapidly as a result of substantial acquisition and purchased an additional 250 laptops from Mayfair. So Mayfair then estimated that the customer purchases would exceed the threshold for the volume discounts in the year to 31st December 2017. So in the second quarter now, because he has bought additional 250, now we are assuming that this guy will meet up. So, and we are estimating that he will get the volume discount. So this question is saying we should calculate the revenue of Mayfair. The revenue Mayfair will recognize in this first quarter and in the second quarter. So it's very straightforward. In the first quarter, now the revenue is going to be recognized is this 17 naira times 500 naira times the selling price, the original selling price of 500. Because now, yeah, we said it will not meet up with the volume discount. So there is no reduction for him. So we simply recognize 17 naira times 500 naira. That's around, what is that? 35,000. But now, in the second quarter, he bought additional 250. So we estimated that it will meet up. So the impact of that is this. That means we are going to recognize this 250 at the reduced price. Also, we need to now update the price of the earlier 70 we sold to him. We need to remove 15 naira on each one. Because now, based on new information, we know that, okay, this guy is going to meet up. So for that reason, you would enjoy those discounts retrospectively. That was what the question said. Therefore, so the revenue recognized is 250 times 450, which is 12,500. And the 70 we sold before, we are going to reduce it, the reduction in price, because we recognize 500 naira in the first quarter. But now that we know that it's going to meet up, so we have to reduce it by 50 naira on the 70 we had recognized before at 500. So we're going to give him a discount of 3.5. So by the time we take away this 112,500 minus 3.5, the amount to recognize in the second quarter is 109,000. And that is what this step 3 is actually talking about. When we say that, we should determine the transfer price, and you have to consider variable consideration. So that's majorly fundamentally talking about where there are discounts. So the examiner will give you some estimates like they have done for us here. So that guided us. So here you will see that we recognize revenue at 500 naira. Here we recognize it at 450 naira, together with the ones we have recognized at 500 before. We now reduce the price by 15 naira. So which impacted the revenue recognized in quarter 2. Now, the next one, which is step 4, is to allocate the transaction price to the performance obligation. So when we have our transaction price from step 3, which is the selling price, then we need to allocate it to performance obligation. Why is this one even coming up? Let me give you an example you can easily relate with. Our net worth, for example, now. we provide tutoring service and we give free books. Based on my analysis in step 2, I already told you that those books can be a separate performance obligation, right? Even though, for example, now in our physical class, one paper is 40,000, and that one course, the student attend classes and we also give him book. What this step 4 is saying is this: even though the student does not pay directly for those books, we need to allocate part of that transaction price to that book. We have to find a way to allocate it. And this standard is saying that, how do you do that? How do you do that? It's saying that each separate performance obligation, you need to allocate transaction price to it in the proportion to the standalone selling prices of those goods or services. So we need to identify what, if we're going to sell each of those services separately, how much? That's what we call standalone selling price. It is that we are going to use as a basis for allocating the transaction price. You appreciate this step 4 with an example. Let's look at this example. It says that a network service company gives customers free handsets when they sign a 2-year contract for the provision of network services. The handset has a standalone selling price of 200 naira, and the contract is for 40 naira per month. How should revenue be recognized? Fantastic. Now look at this question now. There's a network service. Let's take, for example, MTN. So they give people handset for free, phone for free. But they will say that you have to sign 2 years contract where for internet services, network services, and you'll be paying 14 naira per month. And that's all. So they give them that handset for free. But this handset has a standalone selling price. See, ordinarily, the handsets and the network are separate performance obligation because the customer can enjoy the handsets on his own, right? The internet also is a separate performance obligation. So even though the only money the customer is going to pay is 14 naira, which is the transaction price, 14 naira per month anyways, for 2 years, you see that 14 naira per month, we must share it. You don't recognize that revenue as a singular item, network service. No, you need to allocate that 14 naira per month between the handsets and the network service because they are separate performance obligation. Then how do we do this? The standard says that you allocate in the proportion of their standalone selling prices. So how do we get their standalone selling prices? The question will give us. Here now, they already gave us the standalone selling price of the handset, which is 200 naira. So which is what I'm going to use here, 200 naira. For the network contract for 2 years, the customer is paying 40 naira for 24 months. The standalone selling price for this network service is 960. If you add this 200 and the 960, it gives us 1,160. Then we take the proportion. So this 200 all upon 1,160, that gives 17%. And 960 all upon 1,160 gives 83%. It is this 17% and 83% that we are going to use to allocate the money received, the money that is received, which is, if you do 40 naira multiplied by 48, times 24 naira, that will give us like 960 naira. Okay, so we use this to allocate it to each of those items. So now, since the total the total money we are collecting in this transaction is 960 naira, which is 40 naira per month multiplied by 24 months, which is 2 years. This 960, we are going to allocate it to the assets and to the network in the proportion of their standalone selling prices. So in year 1 now, because This contract is for 2 years, and in accounting, it's periodic. We recognize revenue year by year. So we cannot recognize the entire 2 years at a stretch like that, year by year. So in year one now, the ansets, the money we are expecting to receive is 960. So we have done the allocation above based on their standalone selling prices. We are saying allocate 17% of the money we receive to the handset, which is 162 naira. Then the remaining 83%, we allocate it to the contract, to the network. But since the network is going to last for 2 years, so that's why I'm dividing it by 2, so that we recognize the one that relates to this year as revenue. Then next year, we recognize the remaining as revenue. So if you divide this by 2, we get 399. So for the assets, we are going to recognize revenue of 162. For the contracts, we are going to recognize revenue of 399, making a total of 561. In year 2, the same thing for the contract. Since we just divided this by 2, so it's still going to be 399. So this is what we mean by allocating transaction price to separate performance obligation. That is usually done in the proportion of their standalone selling prices. Okay, so that's the end of step 4. Do we have any questions, class? If you have any question, let us ask, please, before I go to the final step. Okay, let's go to the final step. Okay, I'm back. My network just went off now. So I'm back. Okay, so I'm sure that you can hear me now back. So let me continue. So step 5 is saying that we should recognize revenue when or as performance obligation is satisfied. So we already know the price we are going to recognize as revenue from step 4. So the core thing is this: when the customer has satisfied the performance obligation, when the customer has transferred the goods or services, then the customer can, when the entity has transferred the goods or services, then the entity can recognize revenue. But when it comes to transferring goods or services, you see, there are some goods or services that are transferred at a point in time. Just like, let's say you sell food, that one is transferred at a point in time. Or let's say you sell cars, something that you just deliver. To recognize revenue for that is very straightforward, because it is as direct as when you have transferred the goods or services, right? When you have transferred the goods or services. So if you have not transferred the goods, you cannot recognize revenue. As soon as you transfer the goods, you recognize revenue. So that one is straightforward. That is when the performance obligation is satisfied at a point in time. But like this lecturing service we are giving to you guys now, ordinarily, if we as network wants to recognize our revenue, we cannot recognize our revenue as the total amount we collected from you and just put that as our revenue. No, because performance obligation is satisfied over time. Over time. So when performance obligation is satisfied over time, you are only going to recognize revenue to the extent of the service you have satisfied or the performance obligation you have satisfied. I can shorten it as percentage of completion. if it's a performance obligation that we are satisfying over time. So let's say as net worth now, let's say somebody paid 18,000 for one course. I cannot recognize the entire 18,000 as revenue now because we have not completed the syllabus. So if I want to recognize revenue to date, I'll just look at what proportion of the syllabus have you completed. Let's say we have completed 80%. Then I can recognize 80% as revenue. Like that. So that's over time. But the challenge becomes there are some instances where you might not be able to calculate the portion you have completed. It's possible. So the standard says that if that's the case, then you should recognize revenue to the tune or to the extent of the cost you have incurred on that project. You recognize revenue to the extent of the cost that has been incurred on that project. So I'm just summarizing all these stories, all what these guys are writing here in a very simple format, and here too that you are still going to see. So you see, I mentioned something that if performance obligation is satisfied over time, like net worth, I gave net worth as an example now. I said we can only recognize revenue to the extent of the services that has been satisfied, that is percentage of completion. But if that cannot be determined, you need to determine what is the cost I've incurred on this project to date. It is that cost you recognize as revenue. You see, the name IFRS 15 called the cost incurred on a project. We call it contract costs. It defined it as the cost of obtaining or the cost of fulfilling a project. The cost of obtaining and the cost of fulfilling a project. So usually, when we have contract costs, the nature of the cost is what will determine how you recognize the cost in the books. There are some contract costs like sales commission that you will just expense, put in your P&L. There are some contract costs that will require that you buy an asset. In that case, that will be capitalized. So contract cost, the recognition depends on the nature of the cost. That's one. Another term I need you to have at the back of your mind is contract assets. Contract assets. You see, a contract asset is a right to consideration, is a right to consideration in exchange for goods or services that the entity has transferred to a customer when the right is conditioned on something other than passage of time. This is saying that when you transfer goods or services to the customer, but your consideration has not been paid, you have not collected money from that customer, you cannot quickly go and call that trade receivables, which is what a lot of people would call it. He said that you should call it a contract asset if you are still expected to deliver some future performance. If there are still some expectations from you. If, for example, the customer says that I need to confirm that the product is working well before I can pay your balance. If the customer says that you need to do some things, you need to fix some things before I can pay your balance. So whenever your money is conditional on future performance, is conditioned on something other than passage of time, that money that you have not collected, that credit sales is a contract asset, not a trade receivables. A trade receivables, which we generally know, is a right to consideration that is unconditional on anything. It is unconditional. That it is only passage of time, or that it's just that the payment is not due. That is, you have transferred the goods. There is nothing stopping your money. It's just that the customer has promised that he's going to pay at the month end. That one is trade receivables. In fact, if you sell goods to a customer, the customer has not paid, or you have not collected your money from the customer, and you did not issue an invoice, you cannot recognize that money you have not collected as trade receivables, because it's conditional on you sending an invoice. So it's a contract asset. That is a contract asset. So you need to be able to draw a line of demarcation or distinction between a contract asset and a receivable. You need to. And I hope you have understood from my explanation. Another one is standalone selling prices. I mentioned this earlier, and I said that this is the price at which the entity would sell a promised goods or services separately to a customer, which is almost the same thing as transaction price, except that the transaction price is like the contract price, is the price on the invoice, is the amount of consideration the entity is expecting for the goods he has transferred. If you look at it deep down, this one is like the selling price, is the amount on the invoice, transaction price. It's similar to this, just that this one is only applicable where we have contract modification or something like that. So that's where we'll be talking about standalone selling price, which is like saying that, okay, is this the price we will have sold it separately to the customer? Then if those contexts exist, then we are talking about standalone selling prices. And don't forget that contract liability would be recognized and presented in the statement of financial position as a liability when you have collected money from the customer, but you have not transferred control of the goods, or you have not transferred the promised goods or services. And there are some disclosures requirements here, and that is it for IFRS 15. So I kind of asked some question in the past. I put it at the back of your notes. These notes, you have it, I've sent it to you. So they have asked that you should compare with an example where necessary, contract liabilities and contract assets. I've explained it earlier. Standalone selling price and transaction price. I've explained this one. I liked the criteria to assess a contract. This was the first thing I taught you. Explain what is meant by contract modification and state 2 ways in which it can be accounted for. These 2 ways is the one when I mentioned that it's either a result in a separate contract or termination of the original contract and creation of a new one. I mentioned all of this in this class. I already put the solution for you here. And there is another one, November 2021, that says we should explain the core principles under which IFRS 15 is based. I explained this, that the core principle is that the revenue recognized in P&L must depict the consideration an entity is expecting from the transfer of promised goods or services. And they also say we should briefly explain the 5-step model. So that means they want you to say short words on the 5-step model. It's just 5 marks, so nobody's expecting you to write a thesis. It's just short notes on each of these points. I have the solution here for you. So just to make life easy for you. And that is the end of IFRS 15. And that will be the end of our class today. Next week, we are going to be looking at ratio analysis next week. So I'll move to ratio analysis next week. Then I just quickly want to resolve ratio. And there are some sundry small standards I want to teach you, like IFRS 5, IAS 40. Those ones are short, so I'll teach it in a class. Right? When I'm done with that, then we'll start solving past questions on published accounts. Then we still have like 3 weeks class or more or less for us to round up this class. 3 weeks, will be done. Okay. Any question? Any question? All right, class. If there are no questions, so I guess that will be next week then. Bye-bye. Do have a wonderful night. Good night, everybody.
Good night. Thank you.
Yeah.